Yeah, I'm ready.
Okay, can't see you though. Right. Okay. Okay. All right. Welcome everyone to our webinar tonight. So, my name is Imran. I'm from Kenanga Futures. For your information, today's session is a joint collaboration with Chicago Mercantile Exchange Group. This webinar is to create awareness and provide educational on listed derivatives to the participants. Please take note that the futures option involve substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purpose. Kenanga Futures accept no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. Okay, so today we have David. David is a full-time proprietary trader with IcebergX Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. He has done extensive research and is well versed in commodities and indices market. And he also provides frequent commentaries for media outlets such as The Age and Business Times, and holds a chartered market technician designation. So without further ado, let's welcome Mr. David. David, over to you.
Yeah, thank you, Imran.
Right,
So I'm just going to do a quick sound check and also a
right.
slide check. Are you able to hear me?
Yes, I can hear you loud and clear.
Okay, can you see my slides as well?
Yes, I can see your slides.
Okay, yeah, thank you.
Thanks, thanks.
Thank you, Imran, for a very kind introduction. Firstly, just like to thank the audience also for joining us tonight. So hopefully you had a good dinner. And also just to thank Kenanga Futures, for inviting me to speak on today's topic entitled "A Comprehensive Guide to CME Agri Commodities." So if you are new to trading commodities, especially for CME products, and in particular the grains, we talk about soybean and corn and wheat. Hopefully the next 5 minutes or so, hopefully you can gain some insights on how you're going to start your trading when it comes to agriculture commodities. So I just reiterate what Imran just mentioned. This this webinar is purely for educational purpose. So any opinions that you hear from me is basically my own personal opinion, doesn't reflect any opinion, whether it's from Kenanga Futures or even from the exchange itself. And the content itself is purely for education. And also, if you are new to the futures market, dabbling in any forms of derivatives, whether it be futures or options market, does involve substantial risk. And always make sure that you're well educated. Make sure you have you gain substantial resources before you actually begin your journey. I believe in this regard, Kenanga Futures can able to help you. And always seek a licensed representative whenever you embark on your futures trading. Now, this is the agenda. I think in the next half an hour to 45 minutes, this is what I'm going to cover. Now, I will start off with looking at commodities by assessing the fundamentals of the commodities itself. So looking at basic demand and supply, because commodities are very driven by demand and supply. So whenever you have a product that is high in supply and you have low demand, normally you see prices tend to be weak. And vice versa, when you start to see a particular demand for a particular commodity is strong, then you tend to see prices for that particular product tend to do very well. So, you can't run away from demand and supply. So whenever if you are new to trading CME grains, you have to also acknowledge that, demand and supply plays a very vital role. Now, if you talk about corn, soybean, it may be a bit new. If you have been trading the Malaysia market for quite some time, so obviously you're very well familiar with palm oil. So a product that you can relate to whenever you trade palm oil is always the soybean oil, which is listed on CME Exchange. Soybean oil and palm oil always has this co-relationship between each other, because technically they're actually a competing product in the vegetable oil market. So whenever there's strong demand for bean oil in particular, you also tend to see a strong demand for palm oil as well. So as if you have been trading palm oil for quite some time, it's also good to look at soybean oil, which is a very closely related product, and that will help you in terms of your journey, trading journey when it comes to the agriculture space. Now, commodities itself also does display certain tendencies. This is what we call seasonality. So if you've been trading palm oil, you probably notice that year end like November, December, or even beginning of the year, January, February, are usually a strong period in terms of prices. We do see that also when it comes to CME corn and grain. corn and soybean. So there's always a period of time of the year where prices tend to do well, and there's also a period of time where prices tend to do on a weaker end. So if you are looking at seasonality and calendar patterns, you tend to notice this type of seasonal play that is quite common when it comes to trading the agriculture space. So if you are new, you do need to understand how the seasonality does have an impact whenever it comes to your trading strategy. Last but not least, I think it's also good that once we understand the fundamental aspect of trading commodities, it's also good to navigate the market through certain trend trading strategies that I'm going to share that hopefully can enable you to start your journey when it comes to the trading agriculture commodities. So some fun fact, I think if you talk about US, CME agriculture, I think US market itself is a very large market, and they are very big producers. So for example, you just take soybean. US used to be the largest soybean producer in the world. Unfortunately, right now they lost the rank over to the South American players, especially Brazil. So Brazil is the largest soybean producer in the world. But nevertheless, I think corn and soybean is a major commodity for the US market. So if you want to trade corn and soybean, you just have to look at CME Exchange because they are technically the price setter, or we call it a global benchmark when it comes to grain prices. Same goes for palm oil. If you want to talk about palm oil prices, people will just look at Malaysia BMD palm prices. So you talk about corn, soybean, or even to a certain extent wheat, we always look at the US prices as our global benchmark. So corn is an important commodity, not only for food. In fact, I think over the years, we've seen the drive of green energy actually drive demand for corn because green energy always talk about biofuel, and corn and soybean are major feedstock for biofuel. So right now, I think it's about close to 40% of US corn demand actually goes to biofuel. But the key point is this. Biofuel demand always relies on oil prices. As long as oil prices are elevated, are high enough, there's always demand for using grains to produce fuel. But obviously, when oil prices is low, that begs the question whether is there incentive to convert corn and soybean into biofuel. So there's always a debate between food and fuel. But it very much depending when it comes to the fuel energy is always depending on oil prices. If oil prices is high, you should see corn and soybean prices tend to do very well. Now, unfortunately, I think we will tend to see that the three major ones are US in US market in terms of grains are always the corn, soybean, and wheat. Now, wheat is much less talked about because the market itself is actually quite in a way it's quite saturated. It's very single out. So whenever you refer to grains, normally we just talk about corn and soybean. So wheat technically because is the fundamentals are slightly different. There's more dynamics to it, and in fact, you look at wheat futures that's available on CME. There's so many type of wheats that's able to trade. Of course, the most common one is a soft wheat, which is widely used as to make your flour. So wheat market tends to be a bit different as compared to corn and soybean. So if you are talking about grains in general, corn and soybean usually is the major focus when you talk about the US agri. Now, slightly different if you are trading US commodity, especially a US grains market, there's always this we call it planting and harvesting calendar, which we need to know because it's unlike palm oil. Palm oil you plant a tree is for 30 years investment. Corn and soybean is not is what we call annual crop. So there's always a window and period of the year where they start planting, and towards the next couple of months there'll be a period of harvesting. So it's an annual crop. It's unlike palm oil is a pre-annual crop. So that this is a major difference whenever you look at the fundamentals of corn, soybean against palm. So for US corn and US soybean, the planting seasons are always starting from April to June. So right now we call it a critical period for the grains market because this is the planting season that we are in, and usually planting seasons are very important because if there's any adverse weather, US is very common for hurricane and whatnot, or weather extremities. That's where you can really drive prices. So every week right now, if you are trading the grains market, there's always this weekly report talking about the planting progress and whatnot. So those reports are very crucial. Now, if you are a trader, you don't like the volatility and the swing in prices, especially during this weekly report release days. So avoid those trading days. So right now we are in a crucial planting season. Same goes for harvesting, which is usually starts around early August or mid-August, right until the end of November. And then that's usually be also a critical period because again, weather is a big impact during those period, because if any adverse weather, that is going to affect your harvesting schedule, and that's going to drive prices. So if you're a trader, you really need to understand when is the planting season and when's the harvesting season, because during those period is crucial, because any weather element can disrupt your planting patterns or even your harvesting patterns, and eventually will drive prices. Now, if you just look at the table below, we have also Brazil and Argentina. If you notice, their planting and harvesting seasons are totally different from the US players. So if you just look at it, right now it's planting in US, but in the South American guys, they are going for harvesting. So technically, there's always a balance, and one is the northern and one is the southern hemisphere. So there's always in a balance. So if you are a buyer of soybean in the world, you always will have an abundant supply coming from US and South American players, because they always compensate each other. So whenever US is going planting, the South American will be harvesting, and there will be therefore supply. And vice versa, when the South American goes for planting, which usually happens towards the end of the year, that's where South American supply, the US supply, is going to come into the market. So there's always a constant supply for both soybean and corn into the market. Now, being a trader in a grains market, especially for the semi-grains, is also important for us to take note of certain reports, which is very crucial. Now, if you have been trading palm oil, you always know that every month we have the monthly report or monthly demand supply coming from MPOB. Same goes for corn and soybean. We always have we call it the WASDE report, World Agriculture Supply Demand Estimate. This is a crucial report, and it comes out on a monthly basis. So it is important, once this report is out, normally prices will take will always have an impact. It would usually in this report, it will tell you the estimate of the demand and the supply, even the stock levels. So you can't run away from basic economics. Whenever they projected there's a stronger demand, normally you see prices tend to be stronger. But whenever there's a stronger supply coming into the market, or stock levels are elevated or higher than expected, normally you see prices tend to correct quite aggressively. So monthly reports are very important. Obviously, right now we are in planting season in US. Weekly progress reports are also very important. So if there's any change in weather or any change in planting patterns, or probably this week because of dry weather conditions, the planting gets slower, normally you tend to see prices reacted, especially in the corn and soybean space. So right now, weekly reports are also very crucial. So again, I mentioned, if you want to avoid those high swing days, where prices tend to be a bit more volatile, avoid those weekly report release days, and trade those non-report days. So obviously, also besides that, we have the quarterly and half-yearly reports. Now, these are all also highly watched, but again, these are more on the longer-term perspective when it comes to prices. So the shorter-term impact will always be the monthly reports and the weekly reports. Now, I just want to summarize in terms of factors that affect grains in general. Like I mentioned, you can't run away in demand supply. Seasonality is always regards to planting and harvesting. Now, reports are also very crucial. There's always estimates, and whenever the official reports are out, it's always comparing with estimates, whether market is it expecting as to what the official report is. So whenever whenever estimates are over bullish or over bearish, price will always react to it. Now, price movement of close substitutes, this is regards to, if you are trading palm oil, so the closest substitute is soybean oil, and to a certain extent, the soybean complex as well. Now, crude oil price is an important element, because I mentioned earlier, high crude oil is a good, grains are important feedstock for the green energy or the biofuel segment. So when you have high oil price environment, that will obviously encourage biofuel producers to produce more, and that means higher demand for corn and even, in fact, to a certain extent, soybean. Now, geopolitics is another extreme, and this is an element that we really can't predict. If you just recall 2 years or 3 years ago, the height of the Ukraine and Russia crisis, you have been trading a weak market, you probably noticed that it was a subsequent 3 days limit up in the exchange. So if you have been holding a short position, you will get caught massively. So geopolitics is an element that can really surprise the commodities market. And right now, obviously, with Trump coming in, with Trump 2.0, there's obviously there's inherent volatility in the market. It's as a trader, we just have to embrace it. But obviously, there's certain strategy that you need to enforce when you face this kind of volatility in the market. Now, weather extremities is another one. And weather is again very unpredictable. Whether you can blame it on global warming or whatnot, but weather nowadays is getting more unpredictable and it's more volatile. So it can create a lot of shock in terms of price shock into the system. So these are the things and factors that we really have to watch out whenever you are trading the CME Agri space. Now, just a brief. Now, if you just look at where commodity index has performed, obviously we have passed pre-pandemic levels, or we are pretty much where we are before COVID. And it's actually quite elevated. So it's telling you commodity prices in general is not to say commodity prices low, but in fact we are at a level where before the COVID kicks in. And in fact signs are showing that certain commodity complex or certain basket of commodities are actually looking at higher prices. And this particular instance would be like precious metal. So precious metal as a commodity is facing a bull run, while other commodities in particular like vegetable oil complex besides palm oil, you look at canola and rapeseed, those prices are also quite elevated. So in general, you can see that commodity prices are quite inflated. And this again will be a concern for, especially when it comes to government policy. So, when you have general rising commodity prices, it means inflation is quite stubborn. And as a result for government policy measures, usually that relates to interest rate. So, again, this interest rate is an external factor, and it also does affect commodity prices. This is again something that you also have to account for whenever you trade the commodities market. Now, just to give you a general demand overall, if you look at commodities in general, we want a strong demand. Normally, that relates to a strong economy. Now, if the economy is not doing well, that means is facing a waning growth. That will have an impact in terms of commodities. So we started off the year very well. I think what IMF projected that this year, when you will release the report in January of this year, things were looking very bright in terms of very optimistically. But I think things start to change whenever when Trump comes into the picture, Trump 2.0 comes into the picture. That's where forecast starts to become more pessimist. So you can see that second half of this year is going to be projected going to be slower growth. That's not in terms of certain countries, but in terms of globally. So when that happens, normally that will be weighing down on commodity demand, because when you have a weak economy, that usually means weaker demand for commodities in general. Now, recession fears. Recession was definitely a talk of town when US starts the Liberation Day back in early April. I think the recession risk in second half will probably as high as 70%, but that has slowly tapered down when Trump 2.0 was when Trump actually announced a reprieve, a 90 days reprieve, especially US and China trade, from 100% tariff right down to 20 to 30% tariff. So I think that give a breather, and I think that recession fear has slowly eased, but again, it's still quite a persistent, it's still a concern, it's an ongoing concern. But when you have a lingering fear and you have a lingering concern, this is definitely going to weigh down on demand over the longer run. So, second half is going to be something that we have to watch out for if you are trading the market. These are the telltale signs that it does tells you that demand is generally going to be weak going into the second half. Now, looking specifically for the product itself, you can get all these reports and data from WASDE or USDA or even CME Exchange. They do have comprehensive reports that allows you to see quite transparently and on a very timely basis, month to month, as to see how the level of stocks is, the production is, and even the demand. So you can look at, in terms of US corn, we're going to be quite bearish this year because production in US is going to be quite massive. For a simple fact that last year, corn prices were actually quite elevated. I think it was trading above $4.50 to $5 per bushel. So it's a very good price for farmers to plant in this season. So it's the same dynamics. Whenever price is good, they plant more, supply is going to go up. Therefore, prices in this season will come down. Now, for the it's always a trade-off, because the arable land is fixed, So if a farmer decided to plant more corn, they're going to sacrifice soybean, and as a result, the supply of soybean is going to be remain quite limited this year. So you can see that it's more bearish for corn, but soybean we can't be too bearish because US production is expected to decline because farmers in general has actually planted more corn rather than soybean in this planting season. Now, this is what I meant. This is basically looking at the weekly progress. As I mentioned earlier, now we are in a planting season in US. So it's a great time, for a lot of traders to always observe on a weekly basis how is the progress of the planting season is. So for soybean, looks like everything is normal. In fact, I think we started off the planting season actually quite well. The planting progress was actually one of the best, I think, back in early April. Slightly bad for corn, but keeping in mind, I think farmers are planting a lot of corn this season. That's why the corn markets is still facing a lot of headwinds because the expected production for corn in the US is going to be quite massive this year. Now, soybean, we can't just look at US and because there's always a bigger player, which is the Brazil supply. And keep in mind now is a housing season in Brazil. And Brazil, if you just look at the trend, is a year in, year out increase in soybean production. There's obviously there's a debate on it. Basically, the arable land is getting wider. That means you are encroaching into the Amazon forest, which is a bad thing. But having said that, I think you look at it, supply of production in Brazil is quite massive, and it's continuing going to be quite record every single year. And if that continues, we're going to have an issue down the line. If there's the demand is not fast enough to cover the soybean production from Brazil and even in the US side as well, we're going to have excess stock levels for soybean in the market, and that will mean that prices can't go up too much, or rather that price will be quite way down. So keep this in mind. I think it's worth to look at if you're trading the soybean space. Have this in mind that production is actually quite massive in the South American guys, especially from Brazil. Now, this is just to show you that it is because Brazil is a very big player. US used to be a dominant soybean supplier since the early 80s right until the early 20s. That's where Brazil came into the picture back in the early 20s and dominate the #1 position. So the largest producer right now is actually Brazil. Now, obviously, the US-China trade war is a very major game card. So, whenever you have a US tension with China, and China being the largest consumer, given its size of the economy, the size of the population, is the largest consumer. So, obviously, US being they used to be the largest producer, they have to rely on China quite heavily dependent on their on the demand for their own soybeans. But right now, China will have another option to buy from, and definitely is going to be Brazil. And you can clearly see from this chart that Brazil slowly gained a lot of major market share from the US. Now, having said that, given this kind of scenario, why US can still remain as especially the CME contract for soybeans still remain as a price benchmark, given the fact that US is no longer the largest producer, is for the simple fact that the market is still liquid. The contract itself is very established. So therefore, it still sets the price benchmark for the global soybean market. But eventually, I think dynamics can change. If this trend continues for the next couple of years or even to the decade, we can slowly see that the pricing power will always go to the South American guys eventually. Now, besides looking at supply, stock levels are another story. So if you look at fundamentals of demand and supply dynamics, we always look at how heavy is the production like, and the next key thing is always look at the stock levels. So US stock levels are projected to be high because again this planting year is going to be a record. Or rather, it's going to be higher corn production for the US market. Soybean, on the other hand, is looking at lower production. So therefore, the stock levels are going to be gradually decline. But these things can change, presuming that weather is normal. If weather starts to get, there's weather extremities down the line, it's definitely going to have impact on prices. So these are the key things that we need to look at if we are trading the agri space. Now, one of the key parameters to look at whenever you are trading grains, especially, is to look at stocks to usage ratio. Now, this ratio is just like, like you look at stocks, your PE ratio. So it's something similar for the commodities market. So stock to usage ratio does indicate to you if it's a low stock to usage ratio, it tells you that, the market is actually very tight. When you have a high ratio, it's telling you the market is actually quite oversupply. So corn, despite US being, record supply, or they are looking at higher supply in 2025, the world stock to usage ratio is actually quite low. So we can't be too bearish on the corn market for a simple fact that the stock levels in certain countries are still quite low. So there's chance that when prices there's chance for prices to rally whenever there's a shortage of supply for corn in the market. Now, soybean, on the other hand, we also can't be too optimistic because you can see that the stock usage ratios are still quite elevated, although the trend does indicate to you is coming down, which is a good thing, but the ratio itself is still showing you that it's actually quite elevated. So there's still abundant, or rather there's still excess stock levels of soybean across the world. Now, this is basically the world. It's not specifically only for the US market. It's also other market, in particular, like South American players as well. Now, let's talk about the demand side. Now, demand side, China is a very large economy. It's a very large consumer of US commodities. So you can see that when China started off coming into onstream into the market, when it enters in the World Trade Organization, you can see that the demand for commodities just pick up, and it was a very bull run in back in the early 20s when they just started into the WTO, or they start their membership into the WTO. So before that, I think China normally was actually a net. In fact, they produce corn, and the consumption of corn was actually very low. In fact, I think they were a net exporter, but I think things start to change back in the late 2000s, or when they start their membership in the WTO. You can see the economy starts to open and starts to prosper, and when that happens, you can see the demand, the drive for grains demand is actually very substantial. So now they are actually a major importer for soybean and corn. And in fact, the domestic usage for soybean is actually very high. In fact, the trends are going higher and higher. Now, whatever they are facing domestically in terms of economic crisis, when it comes to property crisis, always have a dampener when it comes to the overall demand for China commodities. So do watch that space quite closely, because again, when economies is not doing well, especially domestic economies, it will have an impact when it comes to your consumption pattern for grains commodities. Now, China is an important major player or market for the grains. You can clearly see, those days before China actually entered the WTO, pretty much the market for grains are mainly the European markets. Right now, it's totally different. Since their membership or rather China opened up the economy, you can see that the dominance of China in the grains market, especially in terms of consumption, is actually very high. And again, it's quite a sad story. US, used to be a very major player for the China soybean supplies, but right now they lost their position to Brazil. And with this US and China tension going on, it's definitely going to shift the dependence away from US to Brazil, especially for China soybean imports. So it's crucial to watch whether Trump will have to play a very balanced card here. So here, you'll be a surprise to see that a lot of people have a misconception that the US US major export product is people always talk about technology or talk about infrastructure, especially with aircraft and whatnot. But the funny thing is that commodities is actually the number one US export products in the world, and in that regards, it's actually the soybean and corn market. So if Trump wants to get it right, he has to do a trade deal when it comes to the US agri. So this is another space in terms of geopolitics that you have to be careful of as well, especially during this year, in fact towards next year as well, because Trump can announce any measures, and that will usually have a significant impact when it comes to grain prices. So be on the lookout. I think geopolitics is something that's going to dominate the narrative, at least for the next second half of this year and even towards the next year as well. So I'm not going to go too much on US China. I personally believe and firmly believe there's going to be a trade deal. Keep in mind, I don't think Trump will want to discount votes especially from the farmers, and farming is a very important contribution to the US economy, besides services as well. So I believe Trump will always want to consider something that to do with a trade deal when it comes to agriculture between US and China. So yeah, it's just showing you the importance. But what is concerning is that really China is putting less dependence, especially after the first trade war that happened back in 2017, 2018. It really, it really opened the eyes of China importers. They slowly start to shift their dependence away from US. Just to have a backup supply. But keep in mind, some American, although they are large producers, they also have planting and harvesting season. So whenever China will have a problem when it comes to year end because some American guys are going for planting. So the only options are still the US players. So in a sense, there's still a bit of a link between the US, or rather the dependence on US. But you can slowly see that China is gradually shifting that focus away from US and really into Brazil as important supplies for their soybean and corn demand. Now, talking about corn and soybean, I think it's worth to mention, if you are trading a palm oil, I think a close related substitute that you can always mention is the soybean oil market. So, if you trade palm oil, you have seen how soybean oil perform. Both these products are actually quite intercorrelated. And every time you notice that whenever you start to see strong soybean oil prices or soybean oil tend to rally, you tend to also see the same thing happens in the palm oil market. Now, however, there is always this we call a premium and discount between both products. And normally in normal circumstances, we tend to see soybean oil tends to perform or rather tends to price more premium as compared to palm oil. There's a lot of reasons to it. It could be down to cost, producing soybean oil, which is much more expensive as compared to palm, or rather the productivity of soybean oil is much less compared to palm. If you look at the spread between these two products, you can see that generally the spread between the soybean oil and palm oil market usually ranges between 100 to 150 US dollar per ton. But there's occasion where the premium can go as high as 800. We have seen that during the peak of the Ukraine and Russia crisis, where it pushes soybean oil prices way high compared to palm oil. Now, if you are looking at this trade, if you want to look at opportunity in this particular spread, now over time this spread tends to revert to its long-term average, which is about 100, or sometimes back to its par. But there's also occasion where the spread can go massively extreme to extreme levels. Now, if you at extreme levels, you take a position hoping that the spread will revert. It's normally not a good trade because the spread itself can last at the extreme for a long period of time. We have seen that just a couple of years back when the premium spread for soybean oil went as high as 800 US dollar. And you just look at this chart, it technically took about 1.5 years for 800 US dollar to revert back to a par. It will take at least 1.5 years. So it's a very it takes a long time. But there's also a pocket of opportunity which I want to highlight. So whenever the premium turns into a discount, which means that the bean oil has actually become cheaper compared to palm, or rather palm oil is overpriced. There's a good opportunity for us to take a view, in a sense that that usually means that palm oil the upside is going to be limited because bean oil now is cheaper. So there's always a demand shift away from palm and into soybean oil. So there's a spread trade that you can imagine there. But again, like I always emphasize this, the spread or the premium can stay for quite a long time. So the reversion of mean usually will take a long period of time, and that's where a lot of traders can get caught. So do be careful. But you can use this spread premium and discount as a gauge as to which particular commodity is overpriced and which particular commodity is underpriced. So again, I think right now we are in a situation where palm oil looks slightly more attractive because if you compare to bean oil, the premium is roughly now is about 180 to 200 US dollar on average. So it's just telling you that palm oil is slightly underpriced and rather bean oil is overpriced. Whether that spread can sustain itself, and in fact the spread can even go wider. is much to be seen. But I think there's more opportunity for palm oil right now to perform on the upside, because it looks like, as long as palm oil is cheaper, there's always demand for palm. And when bean oil is more expensive, people will start to divert away from soybean oil and into the palm oil market. So talking about seasonality, if you just look at the 5 years price seasonality for corn, you notice that right now we are entering into May to July period, second to third quarter transition. You normally see corn prices tend to go weaker. And when you go from the third to fourth quarter, especially towards September, October onwards, you start to see prices tend to gain strength. Whether that will repeat itself this year is much to be seen. Again, seasonality can change whenever weather comes into play, whether geopolitics comes into play. It can, it can make the seasonality go out of whack. So it's important for us to use this as a gauge. We can't really use this as a determination of a trade. But having to look at seasonality, it's important to understand that we are now entering to a period where, as for corn prices, it's going to be quite weak. Because seasonality, now we are entering into a weak period when it comes to the second and third quarter transition. Now, soybean is also slightly similar in picture. Keep in mind, right now we are planting season. After planting season, when we want to go into harvesting season, which is towards the third and fourth quarter, normally prices tend to be a bit weaker. But once the harvesting season starts, normally prices will react strongly. So, against a very similar profile when it comes to the soybean seasonality and corn seasonality. So keep this in mind. We are now entering into a weak period in terms of both corn and soybean. So based on seasonality impact, we shouldn't be, whenever there's a rally, we should be more cautious whether can the technical rally sustain itself, because we are now in a period of natural, or rather there's a seasonal weakness when it comes to prices. Now, another important element whenever you trade the CME Agri space is look at commitment of traders report, which is on weekly basis as well. And no, this commitment of traders report is just to highlight to you is that what is an overall net positions that's in the market. Now, just to give you a scenario, if a market that is rallying or prices are going higher and higher, and the net positions are increasing, or net positive positions are increasing, usually that's a good sign. That tells you that genuine people are participating in the market and they believe that the uptrend in the market can sustain itself. So therefore, net positions is increasing. Now, whenever you see an uptrend and the net positions are, especially net positive positions or net long positions in the market are declining, that's not a good sign. It's telling you that, in this uptrend rallies, is probably telling you that a lot of market participants are taking profit or or exiting their long positions. So they are probably believing that this uptrend is not going to sustain itself. So usually that will be a peak in a price rally. So this COT report that entails or indicates to you the net positions is a very important report. It generally tells you you can gauge the sentiment of the market. So right now you can see in terms of the left hand side, the net positions for corn. You can see that right now it's below zero. It's just telling you that we used to be a net long positions in the market. Now we have entered into a net short position. So markets are still quite bearish for corn. And keep in mind, we have seen the reports. Production is expected to increase. It's not looking good fundamentally as well. So a lot of people are expecting that the market can still have room to go further down. So therefore, they're actually taking long net short positions in the market. Now, soybean, on the other hand, is slightly different. We have seen a bit of strength. In fact, the net positions are from net short positions that actually enter into net positive positions. Although those are quite marginally very small, but as long as this trend continues, it's just telling you that the recent uptrend we see or recent price rally that we see in soybean market may have a bit of support, because people are still expecting that the rally can still sustain itself. So do keep in mind. Always watch the COT report when it comes to net positions. If there's any change, especially when there's a decline in net positions, especially during a price rally, that usually be a sign of concern. That usually be a telltale sign there's a weakness in terms of the price rally. So that's pretty much on the fundamental aspect, the certain factors that you need to look at. Especially you look at reports and demand and supply is always very crucial when you look at commodity prices. Now, the second key thing is that, or rather the second part of this webinar is to look at what are strategies that we can use to navigate markets. So I think if you are looking at trend trading tool or trend trading strategies, I think definitely you can't run away from moving averages. One of the key thing to to establish a trend trading strategy is to first identify the overall trend of the market. Now, I always get this a lot, and especially if the trend of the market is an uptrend market where prices are going higher and higher, or the highs are getting higher, the lows are also getting higher. There's always a tendency in people to always find where is a potential reversal in the uptrend market. Now, to time a reversal in the market is never easy. No, for my principle is this: as long as the market is still an uptrend market, always find position to long. Same goes vice versa. If the market is a downtrend market, always find position to short. Don't if you try to time the market or time the reversal of the market, especially if it's an uptrend, you try to short the market because you're afraid to long when the market is too high. But if the trend is in place, if the uptrend is still in place, the market can go even higher. To time the market is never easy, or rather to counter against the trend is never easy, especially when the market is trending. So importantly, if the market is in trend, always find position that trade with the trend of the market. So there's a couple of ways to look at trend. One is to look at it visually or using moving averages. And there's another great tool to look at is, if you are using trend trading style, is to look at Heiken Ashi candles, which I'm going to elaborate more in the next couple of slides. And there's obviously you can incorporate moving averages, and also you can incorporate DMI as a trend indicator for you to pinpoint entries and exit strategies. Last but not least, in any trading plan, you must have a way to get yourself stop out. This is what we call managing risk. There's no point for you to always aim for profit without a way for you to manage risk. Manage risk is equally or more important for your trading success, because if you can't manage your risk well, especially during volatile periods like this, you can get stopped out easily, and you can really affect your psychological when it comes to your trading psychology, and then that will have a very big impact. So always keep in mind, you must have a way to manage your risk. So one of the ways I'm going to share is also to use we call it average true range or ATR levels to manage your risk accordingly. So let's look at this. This is a soybean chart. And if you just plot a 50 period and the 200 period EMA moving averages, EMA stands for exponential moving average, which tends to reflect the prices or envelopes the price more closely as compared if you use a simple moving average, sometimes it's a bit too lag. Having said that, moving averages is still a lagging indicator, but it's good in terms of telling you visually where the direction of the market is heading. So you can see that for many occasions, soybean usually is still a deep downtrend market, right until now, back in early April, and in fact late April, you can start to see that prices tends to move above the 200 period EMA. Whether that can sustain itself is a different story. It's worth to pay close attention to. If prices can hold above the 1050 level, it does tell you that soybean can poise for further upside. But if it doesn't hold, then definitely this market is still going to be a side range market, or worse to worse, it can even hit for a downtrend market. But I think soybean market has actually been a downtrend market since in the mid 2023. In fact, after the Ukraine crisis has eased, you really can see there's a lot of sell-off in both the corn and soybean market. So we used to see $18 in soybean market. Right now, you're only doing about $10. But in the short-term technicals, is as long as soybean is hovering above the 200 period EMAs, is just telling to you there's a bit of strong support over there. So importantly, short-term trends for soybean is still indicate to you there's a potential uptrend in place. Now, corn, on the other hand, it seems to take a breather. If you just look at where back in early March, you can see that really the market was on a major sell-off, because every report is telling you that corn is going to be massive production this year because everybody is planting corn instead of soybean. You can see that from as high as $5, we went down to as low as $4. But of recently, I think we gained a bit of strength because I think the net short positions are also reducing. And again, we can't be too bearish on corn. Like I mentioned earlier, the stock to usage ratio in terms of world ratios is still showing you that signs is coming down. So it's telling you that despite US is going to be abundant supply, the rest of other countries that's producing corn may not be the case. And stock levels around the world are actually quite low. So these are the telltale signs supporting the market. But in terms of technically, you can see that there's still a short-term uptrend for corn market, and it's still sitting well above the 200, sitting well comfortably above the 200 period or 50 period EMAs, and obviously the 200 period EMA. So technically, short-term wise, corn is still an uptrend market, or rather, it's moving from uptrend to a sideways market for now. Now, soybean oil, you can clearly see, one of the ways, once you plot the 50 period, 200 period EMA, as long as the candles are above both the lines, is telling you that market is heading on an uptrend market. So soybean oil is doing very well, and in fact, you should see that it's supporting also the palm oil market. So as long as it's hovering above the 45 to 47 cents, it just indicate to you soybean oil is in a very good position. Now, if I were to show you these two charts, chart A and chart B, if you are a trend trader, normally you prefer to look at chart A compared to chart B. Now, keep in mind, both these charts are the same product and the same time period. The only difference is the type of candles that is being used. So chart A is what we call the candles that's being used is called Heiken Ashi, and chart B is your normal Japanese candlesticks. Now, notice the difference. If you use chart B, your normal Japanese candlesticks, you tend to get a lot of whipsaws. So sometimes the candles can be green and red. You can't really see clear signs of trend here. Now, if you look at chart A, it indicates to you quite clearly when the trends are in place and when the trend starts to taper off. So for example, here you see a lot of green candles. It's telling you that this market is heading for an uptrend. And the moment you start to see the candles are slowly starting to get smaller, it's telling you that, okay, this uptrend is probably going to be exhausted. You're moving to a sideways market. Same goes for here. A series of red candles, very big, long body bars. This market is coming down. So, Heiken actually helps you to, in a way, illustrate the trend, the short-term trends in a much clearer fashion as compared to just using normal Japanese candlesticks. Now, major difference, Japanese candlesticks usually tends to be used when you look at reversals on the market. Now, if you just look at some of the key books or chart reading books, you can notice that, when you use Japanese candlesticks, there's a lot of patterns. And to really master Japanese candlestick, it takes years of experience and many hours of looking at charts, because, the patterns itself, the recognition of patterns itself, there's so many patterns. If you look at Steve Nielsen's handbook on Japanese candlesticks, he talks about 100 over patterns. And to really master 100 over patterns is not an easy task. Now, Heiken Ashi, there's only 3 distinct patterns. And normally Heiken Ashi is used especially to illustrate a trend that's continuous. So it's more to trend continuation. Now, the only major difference, or I would say, in a way, it could be a downside if you're using, if you try to identify gap analysis. If you look back the previous chart, you can see that Japanese candlesticks will show you the gaps. But if you use Heiken Ashi, you can't see the gaps. Normally, you illustrate the price gaps by looking at by the candle itself. So in a sense that if you're trying to use gap analysis, try to use gap strategies, you can't really use Heiken Ashi. You have to convert back into normal Japanese candlesticks. But other than that, Heiken Ashi is a great tool to look at trends. Now, the 3 distinct patterns you need to know is this. First thing is that as long as the bodies are red and green, red means the market is coming down, green means the market is going up. And if there's an upper and lower wicks, normally that tells you it's not a good sign, especially in trend. If you see an upper and lower wicks in the candle, it's telling you that this trend is exhausted or it's going to weaken. Because the high and lows are getting, or rather the closing price is getting very close. So in a sense that, whenever you start to see upper and lower wicks forming, normally it tells you that, generally the trend is going to weaken itself. Now, the second distinct pattern is this. This is one that is worth to look at. Every time when you start to see the body of the candle gets wider, and if it's a green bar, there's only an upper wick, it's telling you that this trend is quite significant. There's strength. And the trend is probably going to start forming. Same goes vice versa. You start to see a red candle bar and the body of the candles are getting wider with only a lower wick. It's telling you that this downtrend is actually very strong. Now, if you start to see a third type of pattern where you start to see the body of the candles are getting smaller and the wicks are very long, almost like a doji, that's where usually it's telling you that market is actually heading to no trend. If you start to see this type of patterns, especially during a uptrend rally or downtrend rally, you should be careful. If you are holding to a position, you should be out, because normally when this happens, it's just telling you that the trend is exhausted, is probably going to hit for consolidation. And when that happens, normally, the market is moving sideways. And if in a sideways market, you can't use trend trading strategy because you get a lot of whipsaws. So just to illustrate that in the chart, you can see that now these are all the series of downtrend. You can see the series of the bar, the body of the bars are white. We only need a lower wick. So it's telling you that this downtrend is actually very strong. Right until here, you start to see the body of candles are small and the wicks are very long, almost like a doji. This is where it's telling you this downtrend is almost exhausted. It's time for the market to consolidate. So during this point, you can't be doing anything else. Already you're holding to a short position, you should be out at this point in time. So let's put into context. So this is basically the soybean market. You can see that, the series of red candles here is telling you that this market is heading downtrend. So once you start to see appearance of green candles and a small body green candle is telling you that this downtrend is probably exhausted. Now, same goes for here. These green body candles are very white. It's telling you that this market is actually heading on an uptrend. Now, again, when this body starts to get smaller, and you start to see a appearance of red candle, especially during a very long green bar, preceding to this area. Normally, it's just telling you that this uptrend is going to be exhausted. So during this point in time, the market is heading to no direction. So if you're holding to a long position, this is a good time for you to exit the market. Now, looking at Heiken Ashi alone may not be sufficient. Normally, you can pair that with moving average crossover. So to do that, you can use two different varying time period. One is a shorter time period, and another one is a longer time period. So you can couple probably shorter time period, look at 9 period EMA, and the longer time period, look at a 20 period EMA. And the crossovers are simple. So whenever the shorter term crosses below, that usually tells you market is going to poised to come down. And you couple that with red Heiken Ashi bars, that's a good signal to take because that usually tells you the market is heading lower. So these are two classic examples where the market heads lower. Now, vice versa, if you start to see green candles and the shorter term crosses above is a bullish crossover, normally you start to see that the market is probably taking on an uptrend basis. Now, I just want to introduce to you DMI. I don't explain too much on what DMI indicator is. You can obviously go and Google it. But what is more important is that DMI consists of 3 different lines. There's the red one is usually what we call a minus DI. The green one usually is a positive DI. So it works the same strategy or similar strategy like a moving average crossover. So what we have here is that the moment the minus DI crosses above, usually it tells you the downward momentum is strong. So it's pretty much giving the same similar signals in terms of bearish crossover, in terms of moving average. So in a sense that DMI crossover strategy and moving average crossover strategies are very similar in terms of their signals. But what is important is that when it comes to the DMI indicator, is the ADX line, which is the third line. And this line ranges is a value line, is based from 0 to 100. So normally, once you identify where the trend is heading, whether it's uptrend or downtrend, the next key thing is to look at how strong is the trend. You don't want to be entering a trend where the strength of the trend is almost weakening. And the way to identify that, you can look at ADX value, which is part of the DMI indicator. So any value that's below 25 usually tells you that there's no trend in place. Now, any value that's above 25, this is a rule of thumb. Any value that's above 25 is telling you that the trend is forming. It can be an uptrend, it can be a downtrend, doesn't matter. But as long as the value is above 25, it's telling you that there's a trend forming and the trend could get stronger. So let's say it goes from 25 to 50, that means the trend is going higher and higher. And anything that's above 50 is telling you there's a very strong trend. So not always, it is a very good measurement. So once you identify where the market is heading in terms of trend, the next key thing is to gauge how strong is the trend, whether are we in a weak phase or are we in a strong phase. So here's a classic example. So you can notice this black line here as part of the DMI indicator. You can see that this is what we call the ADX line. So this red line is basically a 25 value, ADX value. So anything that's below that usually tells you there's actually not much trend in place or there's no trend or clear trend in the market. Now, the key thing is to watch is once the ADX goes above 25, this is where it tells you that, hey, look, probably this trend that's forming is usually can gain some momentum. And when this ADX starts rising, it's telling you that this uptrend that we're seeing, when the bullish crossover or your green Heiken Ashi bars, is telling you that this uptrend is actually quite persistent. Now, notice when the ADX starts to go flat, So this uptrend also starts to go sideways. So when ADX starts to peak or go sideways, normally it tells you that this uptrend is probably going to face exhaustion. And when ADX starts to come down, it's a true indication that market is exhausted. This uptrend is exhausted. So it's a good time, if you're taking a long position, you should be out of the market by this point in time. Now, last but not least, I always mention, always manage your risk. There's many ways to manage your risk. Again, it all depending on individual basis. Some may use, a mental stop. Some may use an absolute value. But for myself, which I want to share tonight is just look at this average true range indicator as a way to manage your risk. So how do we do that? Simple. So for example, is like right here, we noticed or we spotted there's an opportunity whereby, there's a green Heiken Ashi bar, there's a bullish crossover and moving averages. It got confirmed when ADX rises above, 25 level. So it does indicate to you that probably we are in a uptrend rally, and this uptrend rally seems to have a bit of strength. And ATR, which stands for average true range, which measures the range of that particular period. Let's say it's at this point in time is at 3 points on the soybean market. So how do we set our stop loss? So for example, if you have a learn entry at 10.52, your ATR value is at 3. You work on a risk to reward ratio of 1 to 2. That means you are willing to risk, 3 points, but hoping to gain a reward of 6 points. So that's how you manage your risk to reward accordingly. Now, risk to reward ratio, depending on individuals, some may have higher, some may have lower, or also depends on win rate. So there's a lot of dynamics to it, but I'm just using an example of 1 to 2. Using ATR value as a way to manage your risk and your target profits accordingly. Now, keep in mind, ATR values measures the range. So whenever the markets goes into wider range, that means your ATR value increases. So that means you have to be willing to give yourself a bigger buffer of risk because your ATR value increases now. So naturally, that means the volatility of market also increases. Now, if you notice this, every time when ATR value rises, normally it also signals to you that there's actually trend in place. So when markets are getting more volatile, that also generally means that there's more movement or price movement, or the range itself will get wider. Okay. So this is another example. This is just showing you red Heiken Ashi bars, and there's a bearish crossover on your moving average, and ADX is rising. So this is again a soybean example. So this is a short position example. So again, the same principle applies, using ATR value as a way to set your reward and your risk target accordingly. So that's pretty much on technical strategy and looking at things fundamental. Now, I think it's a good time. You have not traded CME agriculture space before. I think now is a good time because I think mid-April this year, the CME just launched the micro agri products. Micro stands for it's a very small contract. If you trade the big contract those days, soybean contract can easily cost you about $1,000 to $2,000. Right now with the micros, you're looking at about only $190 to $200 for margin itself per contract. Now keep in mind these margins can change. Do get the latest margins from Kenanga. Probably they can help you. They can give you the latest margin as to these contracts. But what's so fascinating with this small contract is that if you are new, there's for you to start a contract in the agri space, semi-agri space, it's going to be very easy now. Per contract is only going to cost you about 1,000 ringgit, which is very reasonable. And there's also micro soybean oil. So if you're thinking, if you have not tried the CME contracts, you've been trading palm oil for quite some time, and you think that soybean oil is something that you can relate to, as what I mentioned and shared earlier, you can actually start off with the micro contracts, and it's a good way to start because the contracts are small. So these small contracts gives you a lot of opportunity. And as I mentioned earlier, going into the second half, volatility opportunity is going to be a present because Trump factor is there. He's definitely going to present a lot of volatility to the market, and therefore, if you are in the agri space, it's definitely going to be more opportunity. Now, another concern is that, since the contract is new, is there volume? Now, if you look at it, when the contract first started, no, this is on micro soybean oil. It first started the first couple of days, it was actually quite low in terms of volume. We talk about on average about 200 contracts per day. But right now, really you can see volumes are starting to pick up. Now on average, you're looking about 2,000 to 3,000 contracts on a daily basis. So really you can see traction coming in, especially for the micro agri contracts. So I'm just going to end here with a bit of quote, what it takes to trade the market. So now I just like to quote Alexander Elder. He's always said your biggest enemy is always yourself. So if you want to put judgment, you can't always put judgment on the market because ultimately you make the call. The judgment must be on you. So emotions like fear and greed can always cloud your own personal judgment. So the key thing to always, you want to maintain a successful journey in trading or a consistent journey in trading, you must have self-discipline and self-awareness is always critical. And there's another great quote by Alexander Elder. He always mentioned this. The goal of a trader is not to make the best trade. It's always to make the best trade. It's never about the money. Money is always secondary. So once you get your process right, you make the best trades, money eventually will, or rather success will always will eventually be on your path. So yeah, that's these two quotes is what I want to left you with tonight. So I'm just going to end here and hand it over to Imran for any questions from the audience. Imran?
Right. Thank you, David. It was definitely a fruitful session for all of us. Just for your information, we are currently running a CME campaign on Mighty Futures from the 21st April 2025 to the 30th June 2025. So the eligible participants who successfully open an account with us and trade one contract of CME products will be rewarded with 198 cash prize and RM 190 on brokerage rebates. This reward is applicable to the first 50 eligible participants on the first come first serve basis. Additionally, with every successful account registered with us, we get a free recorded e-learning videos. So here you will learn more on what is future all about. And moving on, we will now look at the questions which has been posted by the audience. Okay, David, we have one question from AAA. I'm not so sure you can see. Okay, this question is, how can we distinguish between short-term seasonality effects and longer-term fundamental trends when trading grains or edible oil futures?
Okay, that's a good question. Now, I think grains, it's going to be short-term seasonality. The reason being is because it's an annual crop. So like I mentioned earlier, there's always a season where you plant and there's a season you harvest. So there's a seasonality that's involved here. I didn't go much in depth regarding this. If there's a common term when you trade the grains market, there's an old crop and a new crop basis. So that is always a seasonality in play. But again, there's other elements that can affect those seasonality. Like I mentioned, external factors like geopolitics, government policies, even external factors, external driven factors, external economies, that can really disrupt seasonality pattern. So if you compare to edible oil, like palm oil, for example, palm oil is a perennial crop. You plant once, it's a 30 years yielding tree. So it's a different mix. So the fundamentals that really affect palm oil is more on a longer term perspective. Fundamentals even for corn and soybean, although it's more to medium to longer term per se, but there's always this element where it's an annual thing. There's always an annual cycle that comes into the picture. So the short-term effect is going to be there. So fundamentals for corn and soybean is actually more short-term, or has a short-term perspective as compared to let's say edible oil complex.
Thank you, David. Is there any questions from the floor before we end tonight? David, there's one more.
Sure.
Yeah. It's from Mr. Key. What role does speculative trading play in soybean futures markets compared to actual supply demand fundamentals?
Okay, that's a very good question. Now, I think the speculative role is actually very, if you compare to the hedges, the hedging role, especially for soybean and corn market, which is a very large market that comprise a lot of players. The hedging role is actually quite substantial as compared to speculative role. But however, there's always instances where prices can go quite extreme, and that's where speculative comes into play. And in fact, you look at it, naturally the market itself the hedges plays a very crucial role. In fact, a very big role. Speculative role is still important, but it's to a lesser degree. So I would say this, just to answer the question, I would say speculative role, when prices are a bit extreme, that's where they are very important. But as long as prices are reflecting fundamentals, hedges will be a more important players in the market, because that's where they usually use the market itself as a function to manage their risk. And ultimately, they are actually giving volume to the market.
Thank you, David. The next one will be, how can traders incorporate the soybean oil palm oil spread dynamics into trend strategies, especially in periods of diverging fundamentals like biofuel mandates or export policy shift?
Okay. Now when it comes to the bean oil palm oil spread, I would say the different fundamentals affect each of the particular commodity differently. So that's why sometimes it can diverge quite massively. Now, to really trade that spread is not an easy task, because I mentioned you have seen, based on the chart, you think the market extreme, let's say for example, the average is about $100. So the moment it goes, let's say 3 times above $300 premium, or if you think a good time to short the spread, hoping that eventually it will revert to its long-term average. Now over time it may revert, but it will take time. How long it takes is a matter of question. So it's to also look at trends in spread itself is also a different dynamics. So for example, right now, you can see that why the spread is widening, because there's a lot of bullish sentiment in the bean oil market as with regards to the biofuel play. But eventually, the spread can eventually narrow itself. Whether palm oil in a way can play the catch up and eventually will narrow the spread. So to really look at trends in spread, it's not an easy, because the things that affect bean oil and the things that affect palm oil could be different. Then eventually the spread can even tear, or it may narrow substantially across time. So really, to gauge the spread based on trend, it's not an easy task. And same goes to whenever the spread goes to extreme and hoping that the spread will revert in time, is also not an easy task, because we've seen that the spread can last for a long period, and that's where it can really kill off the strategy.
Thank you, David. I think there's a next question from Mr. Shufa'at. Do you trade coffee?
Okay. Unfortunately, no. Coffee is a very tough market. First of all, to get reliable sources and data is not cheap. And coffee itself is, if you compare to corn and soybean, is kind of illiquid. There's still liquidity on CME exchange, but it's not as liquid or not as deep of a market as compared to corn and soybean. So because of that factor, and because the accessibility to understand the market itself, without data and without transparent data, it's not going to be easy. So as a result, if I don't understand the market, it's a market that usually I avoid.
Right. Thank you so much, David. Is there any further question before we end tonight? Okay, before we end tonight, there will be our next webinar will be on the 9th June. Will be on the 9th June, and it will be on crypto. If you'd like to join our next webinar, please do register. Via the link in the chat. Thank you so much. David, there is another one from Mr. Shubhat. Can we do hedging between corn and currencies?
Sorry, corn and currencies?
Yes.
I mean, I never explored that perspective. Corn and regards to commodities and currencies, I mean, I'm not sure the interlinkage. So honestly, I can't really comment on that because I don't really explore that particular path. Hey, Imran, over to you.
Okay, thank you. Right, giving another 5 more seconds for any further
Sure.
questions. Calling once, calling twice. Okay, thank you, David. I think this will be the end of our session tonight. Thank you so much. So if anybody have any further questions, you may email us at kfsales.retail@kenanga.com.my. I'll just put it on the chat. Thank you so much, David. Good night.
Sure.
Good night, everyone.
Thank you.
Thank you. Thank
Thank
you,
you,
everyone.
everyone. Thank you.
Thank you. Bye. Bye. Good night.